Welcome to the Fintech One-on-One podcast, episode number 300. This is your host, Peter Renton, chairman and co-founder of Fintech. Today's episode is brought to you by Fintech, the world's largest digital media and events company dedicated to all things fintech. Fintech offers programs throughout the year to the fintech community, such as engaging webinars, white papers, a weekly news show, a daily newsletter, and our newest offering, Fintech Features, a program that helps fintech companies amplify their announcements. Find out more details on all these offerings at lendit.com. Today on the show, I'm delighted to welcome Michael Bourque. He is the CEO of LendingHome, a position he's held since December 2020. Now, LendingHome is well known to many people. They are really the leaders in the bridge loan space for people doing fix and flip type real estate transactions. And they've done over $7 billion in loans. And we talk about the housing market here, the fix and flip space specifically. We talk about their new rental financing product. We talk about the impact of the pandemic on not just the investor side, but also on the borrower side of the business. We talk about the loan performance that they've seen throughout the pandemic and when they return to normal. We talked about the future of the bridge loan space and what's coming down the pipe and much more. It was a fascinating interview. Hope you enjoy the show. Welcome to the podcast, Michael.
Thanks, Peter. Thanks for having me.
My pleasure. So let's get started by giving the listeners a little bit of background. I know you've been at LendingHome for a few years now, but let's just talk about what you did before you got to LendingHome.
Sure. Happy to share that. So my background, I kind of grew up in GE and G Capital. I spent 15 years there on the kind of growing up through the finance ranks and spent about half my time focused on industrial manufacturing companies, as well as the other half focused on financial services, both kind of domestic and abroad. After kind of a great 15-year run there, I decided to do something a little different and joined Ocwen Financial Corporation, which at the time was the fourth largest mortgage servicer in the country, and was their kind of public CFO for 4 years and helped kind of steer the company through a bit of turbulent times, and then joined LendingHome back, I guess, in the summer of 2018 as their CFO and COO, and took over from Matt Humphrey as our CEO in December.
Right. So what was about LendingHome that attracted you back in 2018?
Yeah, it was just really exciting. I felt like I grew a lot in my time at Ocwen, but a lot of that experience was being defensive and was really looking to get back into playing offense again, building and growing a company. I also felt like I'd done a lot of really interesting things in my career, but I had a little bit of a blind spot as it related to technology companies. Mm-hmm. And it feels like if you kind of don't have that experience, you're on the wrong side of history. So, really got to know Matt back in 2015 and got to know the company and what they were up to. And Matt and I stayed in touch over the years. I considered it friendship. He called it long-term recruiting. Anyway, as he was looking for his next kind of operating and finance leader, I was considering what was next, and really just loved the idea of joining the company, bringing kind of my big company background as well as experience in finance and in housing to LendingHome, recognizing that I would also learn a ton from Matt and the rest of the team around entrepreneurship and technology and innovation, and really have enjoyed my time here so far.
Right. Okay. So then maybe before we get right into it, let's just take a step back. And, the housing market today it's interesting to say the least. I don't think anyone would have predicted where we are today 14 months ago when the pandemic hit. I was concerned about my real estate investments back in March of 2020. But give us a little bit of just an overview of where real estate's at today, particularly like in the bridge loan kind of that sort of space. But overall, where is it today?
Yeah, the market's been wild, and apologize for the dogs in the background. Like everybody working from home, you can't predict these things, but it's been a really interesting journey since the start of the pandemic. I think the dynamics that are driving the overall real estate market are also feeding into the bridge loan space as well. And I think if you look at the drivers, it's really two or three things. People with the whole work from home dynamic, people now are desiring extra rooms for an office or two, depending on how many, breadwinners there may be in a family. And given that people can have a lot more flexibility now of where they work, it's created a lot more mobility. And so people are not, necessarily tethered to being an hour, let's say from the office location. And so you're seeing a big migration of people into smaller cities and rural areas, just trying to balance, lifestyle and cost and opportunity. I think the other thing that's happened is you've seen people want a little bit more distance from their neighbors. So instead of people preferring, high-rise condos, apartments, things like that, you're seeing detached homes, yards, all of that becoming much more interesting for buyers and renters. And so as you think about the investment opportunities today, those are really the keys that people are focused on. I think the other thing is, as we're in this kind of still in this pandemic, people who desire those things are less likely to be able to buy something that needs a lot of work. They might be, home, having their kids, be home and having to manage that day to day, as well as their own kind of work from home experience. And so it's really driven demand for move-in ready homes, which, has really set up well for our kind of real estate investor customers.
Right. So I had Matt Humphrey on the show back in, it was like 3 years ago now, back in 2018. And, so I'd love to get an update on LendingHome, what's happened over the last 3 years. I know you said, I saw a press release that came out, I think it was just a week or two ago, about a record month you've had. So obviously things are going reasonably well, but I'd love to get an update of the last 3 years. Yeah,
no, great. And, happy to provide that perspective. The company's doing great. I'm really proud of the team. If I, we reset back maybe to, 2.5 or 3 years ago, when I joined the company, it was really in an inflection point. And so, in the earlier vision of the company, it had ambitions to go into the consumer mortgage market and try to bring its technology and process capability, to help originate residential mortgage loans. And ultimately, for a couple different reasons, the company decided that that wasn't the best strategy. We joke, while everybody in the company was maybe focused on that, our product for residential real estate investors continued to really thrive and found terrific product market fit. And so really at the end of 2018, we doubled down and said, what, this is it's an underserved customer set, incredibly important in the broader housing dynamic and in the real estate environment today. And we really want to continue to serve them well and focus there. And so that's what we've done. We moved away from the consumer space and really today are just focused on residential real estate investors. We did set a record for our production in March. I guess that went out in late April, and probably that record stood for maybe just a few weeks, and we quickly surpassed that. But it's really exciting to see, and I think what you're seeing is that our approach to try to build a one-stop solution across the entire real estate investment life cycle for customers, to help them be informed, to help them find their next property, to help them kind of finance the purchase and the renovation of that project, and ultimately help them monetize it, is really, given us ability to establish these really strong relationships. We're really the only provider out there focused on kind of this life cycle view of the real estate investor. What's interesting is on one dimension, you compete against more of some of the old school lenders who typically serve this space. Right. And we're bringing technology and scale and process, in a way that they're not. And then on the other dimension, you have companies like Zillow and Opendoor who are bringing a lot of kind of end-to-end, support and experience across the transaction, but it's really focused on homeowners and the end consumer. And so, we're really excited to kind of stand alone in this intersection of providing this really life cycle service to real estate investor customers, and it's paying off. Right. So, I know you've traditionally had this the bridge loan product for what is colloquially termed fix and flip type endeavors, but I know you recently added a rental financing product. Obviously, not every home needs to be renovated, I imagine, when it comes on the market so tell us about that. What was the reasoning behind adding that product? Yeah, look, there's a huge boom today in kind of the demand for single family rental homes and investments. But the idea really came from listening to our customers. And so what they were asking for was the ability to, instead of having to to sell a home on the open market to monetize their investment. They wanted the ability to become a landlord and earn income over time. And what's interesting is that kind of buying, renovating, and selling a home is pretty operationally intensive. And over time, it seems like many of our larger customers eventually want to build a passive income portfolio of rental properties that can kind of provide ongoing recurring income for them. And so it really is like a complementary product as they think about building and growing their business. That really got us thinking about this, what are the other ways we can potentially serve this customer set, thinking about helping them across the value chain of all of their activities. And we actually launched a service called the Property Marketplace late, I guess, in the second half last year. But the idea is that, again, listening to our customers, one of the biggest challenges they talk about today is having trouble find their next deal. For some of these professional real estate investors, they'll spend between 5 and 10K of their own marketing dollars, trying to find that next opportunity. And so the idea is that we're building a marketplace for them where they can come. The marketplace is curated, so nothing ends up on that site that we don't believe has attractive economics for a real estate investor. And so we're just getting ramped up there. We've done about 20 transactions so far, but really excited to build out this capability and, again, help our customers, find their next deal and hopefully take a loan with LendingHome.
Right. So can we talk about the loans just for a second here? Obviously, a rental, someone wants a rental property and what's that income stream is going to be, the loan is going to be very different to a bridge loan. So just tell us about some of what are the durations of these loans, or how are the rates lower than the fix and flip? I mean, what are the deal?
Yeah, the single family rental loans it's much more of an established product. There's agencies, banks, non-bank institutions that play a very well developed securitization market, and so rates are, I'd say, above what you'd get for an owner occupied residential mortgage, but still very attractive today given how low interest rates are. So think 4, 5, 6% interest rate depending on loan to value and the characteristics of the property and the rental income, et cetera. And that compares to our bridge loans, which are, as you described, much shorter in duration. These are typically a 12-month loan. And, the idea is that it's taking a property through a state of transition. And so in some ways, our customers are destroying value before they create value in the renovation of the home. But really, it's about typically an 8.5% to 10% interest rate, depending again on individual characteristics. You might have a point and a half of fees up front, and then it's basically set up to pay off. There's interest payments made, but ultimately it's paid off at the end of the loan, and so provides an opportunity for customers to create value in these homes. And we can get into it a little bit more, but through kind of our data analytics and machine learning capability, we really I think have honed in on the elements that drive success here. And so on average, one of our bridge loans is typically about a 67% loan to the after renovated value of the home. And so, generally a higher interest rate, but generally lower risk. When you think about the fact that the borrower is probably creating 30 points of equity as long as they can complete the renovation as expected.
Right. Yeah, it makes sense. So then let's talk about the funding of these loans. I mean, I know the retail investor platform shut down some time ago. So tell us about how you're funding these loans today.
Sure. So the business today, from a bridge loan perspective, is entirely funded through revolving securitizations. And so this is a kind of a program we launched in, I think our first transaction was in April of 2019. And it's akin to how credit card receivables and how kind of floor plan or inventory finance receivables work. But the idea is that you take a pool of loans that have, subject to certain characteristics that are specified in the deal, and you securitize those and sell them to institutional investors in tranches. And ultimately what happens is as loans pay off, you can contribute new loans in as long as they meet the origination criteria. And so these have been really helpful for the company. It's basically a 2-year reinvestment period and then a 1-year wind down. So you get kind of duration of capital. And so you have that certainty. It's also fixed from an interest rate perspective. And so you understand what your borrowing costs are going to be. And so as long as the loans you're originating fit that, kind of the parameters of the deal, you have guaranteed takeout. And that proved to be incredibly important for the company about this time last year when COVID struck. the ability to have a place to put every loan we originated made us unique in the market, where many of our competitors were selling, I'd say, almost like hand to mouth, originating a loan and turning around and selling it on the whole loan market. Well, as a lot of the mortgage REITs and both commercial and resi, were struggling and trying to understand their exposure, they really shut down purchasing whole loans. And so many of our kind of traditional competitors actually had to close their doors for a month or two while the markets, kind of got unstuck. And so, we were able to remain active, to continue to serve customers. And I think that really helped position the company well, again, for these professional real estate investors who've come to rely on us over the years.
Right. And so the rental financing product, is that also, you securitize all those loans as well?
So the rental financing product is still new. We're building up our track record, kind of similar to how we've evolved the capital strategy around the bridge loans. We're hoping to do the same thing around kind of single family rental. And so as we execute more transactions, get more data, we'll continue to innovate around kind of some of the credit characteristics, we hope, and then, move to, that type of securitization eventually. Right. Today we're selling those as whole loans.
Right. Gotcha. Okay. So then on the borrower side, I mean, are these, can you just share the profile of a typical borrower? I mean, how many properties they typically have, how often they come back, are these like small time operators, or how would you describe them?
Yeah, our customers are incredible. They range from kind of professional real estate investors to people who are making their first real estate investment. In a given month, the company typically sees about 80% of our volume coming from repeat customers, and about 85% of the volume is done by, people that we consider to be professional real estate investors. And it's kind of an internal definition, but think about it as people who might do, 5 or more transactions over a couple of year period. And so, companies like this are really like small businesses. They might have their own teams, their own crews. They typically might start in a geography, but expand as they see markets change and see different opportunity. And so, we've really built our business on the backs of these customers and focusing on them and helping them succeed. We have some customers that have been with us since 2015 and have done over, 200 or 300 transactions with us over those years. It's really incredible. We're also excited to serve the people just starting out. It's a big investment. It's a big decision. There's a lot of complexity that goes into these projects. And so whether somebody wants to, think about this as a business full time, or somebody is trying to maybe be a little bit opportunistic, we have a different way to serve them and help them, kind of navigate the process. And it's really important, I think, first, because, what's interesting is if you look at the market, about half of the volume is done by people who are more on this side of the spectrum, and half are on kind of the professional side. So we aim to serve both well. And, ultimately for everybody, we want to make sure that they're set up for success and helping them make a good investment decision.
Right. And so how did those two types of operators handle the pandemic? I mean, did they, obviously, I imagine loan demand went down dramatically at the beginning because no one really knew what was going to happen. But maybe you could just talk us through what it was like March, April, May, June last year.
Yeah. Contrary to what you might have expected, I guess the dynamic in the market that I described, with many of our competitors having to pause or close, actually had the opposite effect with us. People figured out we were open.
Okay.
And I think but it was terrifying because it was like a Friday afternoon to a Sunday morning, we saw like 30 million worth of loan submits come in. And that's usually a pretty quiet period. I mean, you have some activity where we're all online, so people can do that at any point in time. But it made us think, wait a minute, what's happening here, and how is the pandemic going to play out? What is it going to mean for the real estate market generally? How do we think about our capital and protecting our institutional investors and remaining active? And so, in a lot of discussion with our board, our risk teams, and modeling out a bunch of different scenarios, we said, let's be a little bit more conservative. Let's be a little bit more restrictive in our lending terms to make sure we were being responsible facing the uncertainty that we were. And so we raised prices a bit, we lowered leverage a bit, facing that uncertainty. And so through some of those self-imposed changes, we actually saw volume decline. People were themselves, I think it forced them to think, how do I feel about this investment? Or, at lower leverage, do I have the capital to make this investment? And so, customers appreciated that we were still in business. They didn't necessarily love some of those changes. But from there, we really saw activity pick up from that reset in, I'd say, late March, early April. And there was really a steady increase from there as people got comfortable with their ability to execute projects, kind of the capital and cash flows necessary. And really since then, it's been a steady stream of progress, and we've kind of blown through our pre-COVID levels around the end.
Right. So when would you say it was back to normal? What was the month that you would say that, yeah, we're back on target?
I think when we got into, my suspicion is probably around the end of the third quarter, okay. Early fourth quarter, you started to see more of the professional real estate investors kind of come back in force. And then, that really continued, really into and through the first quarter. And now it feels like everybody's engaged.
Right. And then on the investor side, you said you've got that sort of rolling securitization structure, which was obviously a great thing to have in hindsight. But did you see like new investor demand start to, how was that? Did you see it sort of taper off or not?
So we actually were able to do a kind of a private securitization in the middle of the pandemic. So I think it was May, June timeframe. And really what I think institutional investors have seen is first a track record from LendingHome, given a lot of the data advantages that the company has and how we use those advantages to generate loans and help our customers make good decisions. Our loan performance, remained advantaged relative to others. And so people saw that in some of the leading indicators in the pandemic and were still interested. Obviously, low interest rates is a factor, and so people are chasing yield. Bridge loans, I think we mentioned the rates earlier. We don't sell at that rate to institutional investors, but it is a place where investors can go to get yield. And the relatively short duration of our loans, even though people invest in multi-year securitizations, gave people confidence that we could adapt. You weren't making a lending decision today that, like a consumer mortgage, you'd have to wait 7 to 10 years to figure out if you're going to make money. It's typically an 8-month payoff. And so if the market changes, if dynamics change, we'd have an ability to kind of modify our lending terms and course correct. And so, investors stuck with us. The company's loans remained in high demand. And, we actually priced the securitization about a month ago now, that at a kind of all-time low rates for the company, which was terrific.
Okay. And then, so what about the loan performance, like from the loans I'm most interested in that you just, that maybe 3 to 6 months before the pandemic hit, how did they fare? Did you find, was there much of an uptick in problems?
So the end result was no. I think the health of the real estate market has provided just incredible liquidity to investors, and that, I think everybody generally is doing a lot better than they would have imagined. Right. I think our performance remains ahead of our peers, and I think speaks to kind of how we originate loans and how we use our data advantages to make decisions. I think what we did though is, we introduced a payment deferral program, and we had customers take advantage of that. And so people who might have been getting to, they might have just listed a property or gotten to the end where they would have typically monetized it. The real estate markets were really not active in March and April last year and May. And so people wanted to extend and wait and see. And so we implemented payment deferral programs to allow them to kind of extend their loans. And ultimately we saw, I think we had over 50 million of payment deferrals of loans who deferred payments. And I think all of them paid off in full, at the end of the day. And so, we were happy to be able to have that flexibility to help our customers, and are proud to see how the loans have done.
Right. Fair enough. So interesting question here. I've been thinking as you've been talking here that, this is a very data-driven business. So I want to just talk about data and what you're looking at. The real estate's a very data-driven business. What is it that makes a deal successful? Like how do you sort of approve a deal to come onto your platform? What are you looking for that would make a deal you would turn down?
Sure. So the company over its, 7 or 8 years now has invested probably $90 million or more in its software platform. to help give customers a great experience, to help our teams, navigate the origination process, but also to both ingest and create like highly structured data that our teams can use, feed into kind of machine learning and decisioning models to help make, good decisions. I think to date, we've ingested over 900 million data points kind of that go into, that have gone into transactions. I think we funded over 32,000 loans so far. And so, with every loan we do, we're kind of continuing to get smarter and identify the characteristics kind of around both the borrower and a property that can help indicate success. And so we've been able to identify, let's say combinations of elements of a renovation that, generally lead to higher risk outcomes. If you're going to do foundation work, if you're going to add square footage, these are all well known in the industry as being extensive, but we can kind of assess the combination of those inputs, to predict, an increased level of risk in a potential loan, and then we also have used it to identify processes inside the company that, maybe, the company started doing because everybody was doing them. But as we've assessed the data, we actually don't need to do those steps because it really doesn't matter or doesn't have a predictive outcome at the end of the day. And so, one example, that we've cited, I think in the past or other places is around bank statements. And so, we're lending money. Typically everybody wants to see bank statements. Well, what we found is that there was really no predictive benefit in the performance of a loan, coming out of bank statements, either the number you reviewed, the ending balance at the end of the month, the average balance, the number of transactions, et cetera. And all you did was kind of, take up, 4 hours of your team's processing time, and you'd typically upset customers because it was a little bit of a back and forth and a pain in the neck. And so that was a process step that we could eliminate and show kind of our end institutional investors that, look, we're not adding risk to the product here. This is actually helping the business overall, and we could explain that through our risk models. And so, over the years, we've continued to, hone in on different elements and continue to refine our capability. Everything from looking at comparables in a market to kind of understanding, the after repair value of a home. All of this, all of these areas are places that we're investing heavily to continue to get better, and ultimately, taking advantage of all the technology changes that's happened around machine learning and the like, have helped make us smarter. I think at the end, one of the data points that we're really proud of is, in the industry today, or I guess over the last year plus, about 75% of people who buy, renovate, and resell a home, will make money on that project. If you're a LendingHome customer, it's about 93%. And so, we view our capability and differentiation as, basically helping our customers make good decisions and driving their success, giving them a great experience, and then hopefully having them come back, and do more transactions with us.
So do you think that's the key? Because it's been interesting to watch this niche industry kind of over the last 7-8 years, and there's some early players are no longer around. Others have struggled mightily. They're still alive. But LendingHome really came out with a bang, really well funded from the get-go, and has sort of become the number one player in sort of the, whatever you want to call it, the digital enabled, tech enabled kind of lending space for bridge loans. So, I mean, why do you think that is? I mean, if you could just isolate maybe 2 or 3 points. I mean, you mentioned some there about the percentages, but how have you able to really maintain this number one position for so long?
Yeah, I think it goes back to the technology advantages that we have. I think the nature of many of our traditional competitors is that they maybe started in one location, they were regional, but they were limited by people and capability. They might have had traditional credit committees and the like. That's not an operation or a model that lends itself well to scale. We're in 28 states today. We have an ability to, again, kind of aggregate and use data to help make decisions almost like you would a local lender. And that's allowed us to serve customers well, whether you're, in California looking at, a multi-million-dollar project in the Bay Area, or if you're in, one of the Carolinas and looking at a 200 to 300K type transaction, we're able to serve those customers equally well. And so, for us, it's really, we've really been focused on giving customers a great experience, helping serve their needs, making things simpler over time, but then, communicating to them and helping them kind of understand, their options around projects, helping them understand what drives success, and then just being there for them, having a high say-do ratio and being consistent, standing by them during COVID. And while, terms may have changed, we've talked about reliability and having and being a well-funded lender like you described, but actually being able to prove that in COVID, I think has just reinforced that, we've grown up to be a great partner for these customers.
Right. Anyway, we're almost out of time, but a couple more questions I want to get to. The housing market is hot. I mean, there's nationwide high demand for housing. There's not enough houses to go around, basically, right now, is what people say. But how do you view the future of the sort of the bridge loan market, the customers that you're working with? I mean, is there a lot of room for that market to keep going up?
I believe so, and I think it's actually the beginning of a terrific cycle or maybe the extension of a terrific cycle for real estate investors. If you look at what's happened in the country, there's a housing supply shortage at a time when there's a spike in demand, and that spike in demand isn't going to ebb or reverse anytime soon. You've got 60 to 70 million millennials entering kind of their prime home buying years. That's going to continue to drive demand for homes. The supply shortage is decades in the making. And so, ultimately, what we're looking at is, the housing stock today in this country is the opportunity. 2/3 of homes in this country are more than 30 years old. There's $25 trillion of value in those aged homes. In the over $7 billion of transactions LendingHome has done, we've helped our real estate investor customers create over $3.5 billion of value in those aged homes. And so as you think about the housing dynamic over the next decade plus, people want a place to live. Those first-time home buyers in particular are going to be more price sensitive. And, thinking about buying a new home, that's more expensive now because of all the input costs and everything that's happened with lumber and the like is becoming increasingly expensive. There's really an opportunity to move in, to move into a refurnished home or refurbished home, one that's move-in ready, kind of prepared, from our real estate investor customers. And so, we're really excited for the opportunity to kind of help the country here and think it's really going to be an interesting market for many years to come for real estate investors.
Mm-hmm, mm-hmm. Okay. So then last question, I mean, given the unusual 18 months that we've all gone through here, I'd love to get sort of your perspective as, I know you haven't been CEO that whole time, but what has LendingHome learned, or what have you learned over the last 18 months that will really help you in the future?
Yeah, I think first is we've got to continue to go out of our way to serve our customers well. We would do some things different back in our response to COVID. Obviously, I think many people would with everything that we've learned, but protecting those relationships, supporting those relationships and building on those is just critically important for our business. And so that's never been more clear for us as a company. I think secondly is just how important it is to take care of your team. Everybody's gone through a very different kind of lifestyle change, if you will, through the pandemic. Somebody who has teenagers like myself has a very different experience from somebody who might have toddlers or kind of elementary school age kids trying to learn from home and what that means for lifestyle, ability to work. It's just reinforced for us to help, make sure we're taking care of our people, whatever they need and whatever their situation might be. And then the last thing I'd say is we've really learned, and I don't remember who this quote is attributed to, but over the year, I read somewhere that tough times never last, but tough people and teams do. And so, I'm just really proud of the LendingHome team and how they came together in a really challenging environment and have come out the other side, really thriving as a company. I couldn't be prouder of how everybody's rallied together to serve customers like we have, and really excited for what the future holds for us.
Okay, well, on that note, we'll have to leave it there. Michael, it was great to have you on the show. Best of luck. And yeah, it's going to be exciting to see what the future holds.
Sounds great, Peter. Thanks for having me.
Okay, see ya. So I've been a beneficiary of this system. The house that I live in was built in 1955 and then bought and rebuilt in 2016, which was when we purchased it and moved in. And so I'm a big fan of the concept. I get redeveloping old homes for the modern tastes is a great use of resources. Now, and the fact is, as you said, there's 60 to 70 million millennials looking to buy houses. The real estate market has just been upended in many ways, just because people now are no longer tied to their job, and that is something that's a trend that probably is not going to go away anytime soon. So, the fact is that there's not enough houses for people to live in right now. It's going to drive up prices. It's good news for the developers on LendingHome. Not great news for first-time home buyers, but we live in a supply and demand world, and that is really the case where one of the driving forces behind the growth in real estate. Anyway, on that note, I will sign off. I very much appreciate you listening, and I'll catch you next time. Bye. Today's episode was brought to you by Lendit Fintech, the world's largest digital media and events company dedicated to all things fintech. Lendit Fintech offers programs throughout the year to the fintech community, such as engaging webinars, white papers, a weekly news show, a daily newsletter, and our newest offering, Fintech Features, a program that helps fintech companies amplify their announcements. Find out more details on all these offerings at lendit.com.